Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com looks at the major markets and how oil dipped into territory it had never seen before. He tells us it's not the only commodity that has slipped into the negative. Publisher of the newsletter Rick's Picks, Rick Ackerman, comments on what he feels will work in our shaky markets and also has an idea that would help the homeless, the unemployed, and infrastructure needs all at the same time. Wolf Street's Wolf Richter examines how various aspects of the economy have been hammered by the virus crisis and what to expect in the automotive sector. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMY.Resources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Yeah, it's always a pleasure to be with you, Jim.
Ross, we had the wildest week ever in the oil market. What was behind negative prices?
Well, clearly, everybody's been telling the story about the supply being as big as it has been this year, and then Russia and the Saudis trying to come to an agreement, which they finally did, but not enough to really help out because of the coative problems that we've had and the lack of demand. But, this is a sort of an accident that was waiting to happen. You have these futures contracts which trade at a premium, and as you move out, a year from now, even though we've got the current spot price trading around $16 today, as you go out about a year from now, it's trading around $30 for the forward contract. So over time, you've got that constant erosion occurring in the oil market. And the big positions most recently have been held by the ETFs. The OIL and the USO ETFs were holding over 50% of all futures contracts. And most of that speculative position, when you think about it, is by people who are looking to find bottoms. They're not short these. They are long these products in anticipation of a quick little pop. So by the time we got through the last week or so, the open interest going into the weekend before the expiry, we had over 108,000 contracts of the May crude oil, which in terms of the outstanding number of contracts in New York on crude oil, that's extremely large. Usually, only 1 to 2% of futures contracts end up in physical delivery. So to have a position as large as that was just unheard of. And when we look at the breakdown of it, the commitment of traders numbers from the 14th showed that the speculative position was long about 700,000 contracts. They were short 189,000. The commercials were long 822,000, but they were short 1,377,000. So the commercials were the ones who were making the good money on the way down. And they clearly were willing to give delivery. Any of the producers who had sold forward, they had absolutely no reason to think about covering the positions. They wanted to deliver into these contracts. But there was no place to put the oil. And so this then became a pretty special situation. And I tend to look at a few points in history where the exchanges have done something that's really, really been to the benefit of the members of the exchange and the old boys club. In terms of crude oil this time, they changed the rules to allow it to trade to negative pricing. And so we ended up with that debacle, prices on Monday dropping down below 35 to minus $35 a gallon. And then as the positions were liquidated, which they had to be because we were coming up to the expiry of the May contract, prices have bounced back, and you've got the June trading around $16 right now. Still very, very cheap. But that change in the rules allowed huge, huge profits to be made by the short positions. And when I look back, I think to myself, and I remember days, there was a Maine potato contract back in the 1970s. So it's a contract that calls for delivery of Maine russet potatoes of certain quality, and there was a real shortage going to happen in that product. And I had clients who were long Maine potatoes in anticipation of a good squeeze. And the best money is made when you find in an abnormal condition where you're going to have a really nice run. And the exchange, because they didn't want to see the short squeeze happen, they just prior to the closing of the contract there, rather than letting it run, they called for settlement as of the previous day's close for all long and short positions. I had clients who had been long, ended up losing money because the exchange wouldn't allow the price to run and to have its natural course of longs and shorts offsetting their positions. Then, in January of 1980, the one that most people will remember, is the silver market. In late 1979, the Hunt brothers started to become a big known entity as far as their positions in silver were concerned, and there was a squeeze going on. We ended up with not just silver, but gold also making a good run in that last quarter of 1979. And as we got into 1980, silver was trading, there was bid limit up every day consecutively for a couple of weeks because it could only rally $1 per day. That was, it didn't have expanding limits like we do now. And so the only way that you could take full advantage of the price was to sell the forward or sell the cash market and do a spread within the futures market. And so we were doing this all the way up, and you could, anybody who wanted to liquidate a contract wasn't held back by just what the limit move was in the futures contract. They could trade the spot contract and do the spread, so they got full advantage. Well, as silver went into the top, the exchange changed the rules. And they said, we're going to only allow trading for liquidation. So liquidation only. You couldn't do the spread trades anymore. And, they were saying they were trying to prevent this big short squeeze and, make it more realistic in terms of pricing. But in reality, anybody who wanted to take profits from about $42 up never got the opportunity to do that. Because with no ability to put on the new position in the spot month and then do the spread, you were limited to just where that futures contract was stuck. And so, wouldn't you know it, silver topped, the futures contracts then started going limit down for consecutive days. So, that type of rule change clearly benefited those who were short and were looking for some help from the exchange to manage to get their positions settled out at a reasonable level. And then we had another one where the cotton market a few years later, USDA came along, changed the rules in terms of what was an old contract month and what was the new contract month. Because in a contract where you have an agricultural commodity with a crop year, there will be big difference in pricing between the old crop, where you might have a shortage of supply, and the new crop, where there would be a good amount of supply. Well, they changed the rules in terms of what was old crop and new crop. Got caught once again. The old crop ended up going limit down consecutive days. The new crop ended up going limit up. So here we are with crude. They take off the rules regarding the ability to trade to a negative number. And personally, as I see it, this was just a huge benefit to those major commercial short positions. I'm a cynic when it comes to things that are in the market, and this one really, really stinks.
Now, the Canadian dollar is very dependent on the price of oil. Anything wild happened to the Canuck buck?
Well, Canadian dollar took a bit of a hit. Now, we have to recognize that, the June contract in oil is now the lead contract. It's around 16. It was around 23 or so early in the week when everything happened in terms of the May contract. So Canadian dollar took a bit of a hit early in the week. It had been up around 72 cents, dropped down to 70, and I think just over 70 cents. Bounced back. We're sitting around 71 at this point. So you've got it stuck between let's say a 70-cent support level, 72 on the upside, stuck in a trading range, and unless oil really does start to come back to life, and that's going to need the economy coming back and the demand for gasoline and oil picking up. I think the Canadian dollar continues to stay under pressure. That 72-cent level should be looked at as a pretty important resistance.
Ross, so overall for the week on the markets themselves, pretty choppy again, a roller coaster up and down.
Yeah, a day or two up, a day or two down. A week ago, we were talking about the fact that the S&P 500, the OEX, the NASDAQ, all had what we call sequential nines. That was 9 consecutive days closing above 4 days earlier. And we had retraced, depending upon the index, anywhere between 50 and 60% of the drop into that March the 28th low. So this was a good place for a consolidation to start, and in particular, if this consolidation starts to run out of steam, and that would be a takeout of Tuesday's low, as far as we're looking at it right now. If it starts to roll down through there, then first thing you should be looking for is a 50 to 60% correction from that March the 28th low. That would be, an optimum pattern as far as we're concerned. So good resistance in terms of what we've been up against this week. The NASDAQ has been, the leader coming off the bottom, and the Russell 2000, the small caps, have just not had much of a bounce at all. So trade the strong ones on corrections, and sell the weak ones on rallies as far as the indices and the stocks are concerned. You want to go with where the follow the strength. Don't try and do too much bottom picking on the weak ones, because they're weak for a reason.
Small mining companies, did they have a good week?
Better week. There's been a lot of good life as far as the mining indices are concerned. The gold market, actually, if we take a look, like the GDXJ, got right back towards the February highs, which also were back to the August highs. So this thing is got a pretty good level of resistance up here right now. Wouldn't be at all surprised to see a correction. It's interesting, this whole action of the last couple of years when we look at it, both in terms of the miners and in the metals, is very, very reminiscent of the 1970s. Back then, gold had a major rally into the end of 1974 as Americans were going to be allowed to once again own bullion. It had gone from, $35 to just shy of $200. Silver had gone from about $1.25 to $6. And then into, following that peak, gold dropped in half, dropped down to $100 by the mid-1976. And as we worked our way through the second half of the 70s, gold just stair-stepped its way up very, very nicely. And by mid-1978, it was back to the $200 high. Silver, in the meantime, had topped at $6 back in 1974, sold off to $4, and then spent right through 1978 doing nothing. It was stuck between $4 and $5, broad trading range, couldn't keep up with the gold market that had gone back to test its old high. And the stories in terms of shortages and demand were all there, the silver was going to be in huge demand. Then by the late 1970s, the Hunt brothers came into the story, and they were buying big quantities of silver, and they did cause the squeeze. But it was only in that tail end of that period from 1974 until late 1978 that silver started to catch up to what gold had been doing. And if we look at what's going on right now, you get the same type of action. Silver had that great run to $50 back in 2011. Since then, we've been stuck in a low trading range. We've had a couple of good rallies, but here we are at silver trading at the $15 to $16 level. And I wouldn't be at all surprised that silver's probably got one more sell-off left in here before I think it then can start to join the parade on the upside with gold, because I do think that gold's going to continue stair-stepping its way higher, and silver at some point is going to catch up. I know that there's stories or the reports that with California going to require new home construction to all be built with solar panels, that'll have a big demand as far as the silver is concerned. That could be an ingredient out there, but technically I think we want to watch to see how silver does on the next bit of weakness. I wouldn't be at all surprised that we get back close to those February-March lows before it's got a chance to take off on the upside. Now, during that same time window of the 74 to 78, we talk about what bullion did, but the stocks did the same type of thing that we're seeing right now. And I've got a couple of graphics. If people want to send me an email, we'll send it out to them, show the sample of just how this action of the last decade and a half is so similar to the late 1960s through late 1970s as far as the mining index was concerned. So I think that over time, buying a hard dip in the miners, and right now they're overbought, but buying a good correction in here probably is one of those great 2 to 3 year holds.
And so for people who would like to take a look at that chart, Ross, how do they get a hold of you?
Ross Clark, ROSSCLARK, at chartsandmarkets.com.
Ross, thank you so much for being on the show.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can also find him on Twitter at Charts by Ross. Coming up, Rick Ackerman next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of Rick's Picks, available online at rickackerman.com. He's speaking to us from Boynton Beach, Florida. Rick, welcome back to This Week in Money.
Thanks for inviting me on, Jim. Lovely day here in Florida, although we're all sequestered.
Rick, what's the latest at Rick's Picks?
We've got, I would say business has been good for one. You know, a lot of people out there are kind of maybe bored and thinking, geez, I could probably while away the hours and make some money trading. So I've got a very active trading room now, and I almost feel guilty, but business has been good. I'm trading myself and not trying to be a hero. The market has been swinging violently, but I've been just kind of trading between the cracks in the same conservative way I would if the market were dull. So anyway, just trying to keep track of things, but the swings have been so wild. Just forecasting for crude oil for one, and some of these stocks that go crazy is we're living in interesting times.
Now, is crude oil still the big story? I mean, earlier in the week, negative oil prices never happened before, likely never happen again, hopefully.
Well, that plays like a big story, you know, it seems so crazy. But when I was a floor trader on the Pacific Exchange, there were similar events. I wouldn't say they were common, but they were not rare either. You know, one usually it involves a delivery problem. So it'd be Friday, just 5 minutes before the bell, and there'd be sort of crazy action in the stock. I remember Levi Strauss closed, I think it was just below 20. And it turns out that a lot of people who had sold call options at the 20 strike didn't bother covering because they were out of the money. But it turns out that you can exercise an option that's out of the money. There's typically not much of a reason to do that, but in this case, if you exercise, the person who sold that option is on the hook to deliver stock, and they have to buy it, and it takes 5 days to get settlement, but the option fulfillment requires you to come up with stock in, I think, 3 days. So the gap between those two created short squeeze conditions, and people on a hook, the stock might be trading for 20, but to buy a stock for instant settlement, you would have to go in the cash market and pay, who knows, $40, $50 a share. So what happened in oil was really something like that. It was just a little quirk having to do with exercise and people figuring out that if they were holding contracts, technically making them, requiring that they take delivery, that there was no place to store the oil. So it's odd that it hit everybody so late in the game, but any professional, anybody who trades oil contracts should have seen that coming, the problem of delivery with no storage available.
Now, I've heard that nobody was really caught out by that because, as you said, if you're a professional who trades in that, it was like a freight train coming down a track blowing its horn with the lights on.
Yeah, but the odd thing is it took the same thing, the same idea, a couple days to register in the June contract. The May contract was under fire there, but the same thing was going to happen for June deliveries, where the storage problem hasn't gone away. So the lesson there is that if you see something that's as obvious as the nose on your face, and the market doesn't seem to see it, place your bet. I mean, the market sometimes can be as dumb as a fence post as far as ferreting out things that are being shoved in its face.
Do the U.S. stock markets look like they're continuing to form a strong V bottom?
I think they're continuing to form a hellacious top. I'm expecting an Acapulco cliff dive, and what we're seeing now is simply short squeeze. It's the way I like to put it out there so you can understand it. Think of the market as being two players, you and Warren Buffett, and Buffett's got $18 billion worth of Apple shares for one that he'd love to dispose of. He's not so stupid. Of course he's not so stupid, but he can see the same things that we do, namely that Apple's business, essentially selling hugely overpriced hardware, is going to go into the crapper. So he's got to unload a lot of that 18 billion in stock, but let's say he has a general approach and he'll just sort of back away from the offer. And with none of the big guys offering any size out there, it doesn't take much short covering to drive the market higher. And if you want to know where the short interest comes from, you just come into my chat room, because everybody's in there every day just trying to pick a top in the E-mini S&Ps or whatever. And it's logical. They're all going to be right. There's every reason to sell the E-mini S&Ps up here at 2,800. I think they're going to go down to 1,200, 1,400. But as long as the preponderance as long as the attitude is bearish, the bears represent buying power, because they've placed their bets against the market. So just to put a number on it, the E-mini S&Ps are up nearly 50 points today, trading at 28.28, and I'm as bearish as anyone out there, but I still think it's going to go to 29.21 before it can top out. And if I put that number out there too aggressively, it's going to get steamrolled too.
Could you see more manufacturing moving back to North America from China just because of security of supply?
For sure. The Chinese have a real problem. They're going to be a pariah state in the world, and I think a lot of Chinese manufacturers, capitalists, may want to work in the U.S. where they've got a better chance of exporting to the world. But China is going to have more difficulty doing that, because if nobody trusted them before, they really don't trust them now.
Yeah, I mean, an example, Canada had medical equipment it was supposed to pick up, and China sent back the 2 planes empty.
Right. And speaking of medical equipment, that's just one other area where the U.S. discovered we're so vulnerable here. There's some things we need badly. Of course, we always knew that was true for rare earth minerals. Chinese sort of cornered the market, but eventually capitalism finds a way to get around that kind of monopolistic control. But it's not so much that Chinese had a monopoly, but they did make quite a high percentage of the drugs that we need, the good drugs. And so the U.S., as a matter of policy, is probably going to be shifting things back to the U.S.
Mm-hmm. And the bad drugs, I think, would include fentanyl, which doesn't seem to be in short supply either. And I think it comes from China.
Right. There's always plenty of bad drugs to go around, unfortunately.
Is there more attention being directed to the gold market?
It's doing nicely, and I think gold is kind of in a middle way here. It's possible to read the strong rally that we've had in gold. The June COMEX futures are trading up around 1740. I've got a target at 1877, I believe it is. And it's easy to think that it's being driven by just this feeling that the Federal Reserve is taking on a bit too much, that it's kind of backstopped the world, implying that it's ready to gin up as many dollars as it takes to keep the, not just the U.S., but the global economy afloat, and the financial system as well. And I think somewhere at the end of the trail there's a hyperinflation, but I've been making the case for deflation for over 30 years. And in the 1990s, in fact, I had that all to myself. There was nobody else writing on the subject of deflation. I had the lunatic fringe all to myself. But I have to acknowledge at this point that the federal government is doing all it can to stoke this idea of hyperinflation. I don't think we're going to see it right away. I think it may be the end game, but I think first we'll see a deflation. And the bottom line is that the asset deflation that's occurring in this world right now is so powerful, it's so overwhelming that the Fed can't inflate fast enough to offset it.
The gold-silver ratio was over 130 to 1 in March. Is this a bullish signal for silver?
I like them both, and to just actually to finish the thought I was just started on before, I think gold, it's not so much that it sniffs hyperinflation, but there's finally, since 2011 when we topped in gold, there's finally enough uncertainty for gold to be rising. You look at it and you think, how can you go wrong? And I think that that's pretty good logic. You're not going to get hurt too badly in gold anything at this point, and I believe that that's really what's given gold its boost rather than the inflationary idea. But as far as the gold-silver ratio, silver has been kind of suffering because it's a poor man's gold, and the big boys they're not dealing with junk silver and things like that. So the push there is behind gold rather than silver. But if you go out there to the dealers and just try to buy yourself a bag of junk or a monster box of silver dollars or something like that, you can't get it. And so this is one of those situations I just mentioned. If you see something that's as obvious as the nose in front of your face and the market doesn't seem to understand, trust your instincts, because silver is way lagging gold here. And you think, what is the problem? Well, don't let that trouble you. I think if you just trust your own nose here, you can smell it coming. That silver is going to have its day as well.
California's just mandated that all new homes have to have solar panels. Solar panels have to use silver for the most part. So is that good news for somebody investing in silver?
That's always been a hard sell, not that the commodity market for silver has not been a factor in its price. For a time when Eastman Kodak ruled the imaging world, there was a lot of silver used in photographic processes, and of course, even in some dental work. But it compared to the way a change in investor psychology can drive silver, the commodity demand for it is relatively insignificant. It'll definitely give silver a boost. This idea that the solar panel market is a good place for silver to sell into. But the bigger thing is when everybody starts getting the idea, holy smokes, the dollar's getting trashed, I better jump on something silver or something gold.
Are mining stocks gaining strength?
They are, yeah. I mean, if you trade GDX, which is an exchange-traded fund vehicle, good proxy for the mining companies, it's had a great move. I got shaken out myself. It was trading before the market crashed in March. GDX was up around 32, and it got halved over a few weeks there into the March 23rd low, and it's more than recovered. It's trading above that high. And as of yesterday, it made a recovery high up at almost 35. So I like GDX very much. It's a good vehicle for playing, a good proxy to own mining shares. And if I can get this chart to work here, I've got a target up at $38.60 for GDX. So it's got a pretty good move percentage-wise to go. And there's that whole universe of penny stocks they've been pretty much neglected for a long time, not necessarily for no reason. They're pretty risky, but some of them are actually doing good things. I'm not going to name names here, but I've got a couple of cheapy stocks, exploration companies, or in particular, give you extremely high leverage to gold. So even more so than the existing mining companies, they're always going to have a play because that's where there's at least a little bit of gold liquidity when the big players, when the portfolio guys start finally including gold. But outside of that universe, the exploration stocks in particular are enormous leverage to assets.
We'll have more with Rick Ackerman when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Rick Ackerman. Rick, do you expect to see continued strength in the U.S. dollar?
Well, I noticed that it's sitting there near 100. It hasn't exactly crashed. The dollar index at 100 is sort of what Irving Fisher back in the Depression days referred to as a permanently high plateau. So the dollar got slammed pretty hard going into that March 23rd low, and the low was somewhere around 94, but it has since rallied as high as 103, and it's come back. It's about 20% off that high right now. So the dollar is pretty strong, and keep in mind that it has withstood some real body blows there to the extent that the Federal Reserve is they're throwing around these $1 trillion bailout packages. There are enough of them that it's amounting to real money. So that's should be very negative for the dollar, but the dollar is strong in part because you've got liquidity problems elsewhere in the world where the borrowers are being asked to settle up in dollars. So that's putting a floor under the dollar. But I'm still hugely bullish as I've been in probably every conversation we have going back years.
Could the U.S. be looking at negative interest rates?
As a matter of policy, no. And it was one thing to take interest rates down on this idea that, well, we need a counter stimulus to the tariff wars, and we need this and we need that. But you no longer have that rationale. You're not making interest rates lower to stimulate the economy. And we have the example of Europe to demonstrate that when rates go down below zero, you're in a liquidity trap anyway. You're not going to get much stimulus. You're not rates below zero are not exactly going to stimulate capital investment. So the only rationale for taking rates down would be the Fed simply saying, we just need to borrow it for less. And I think it would be, even though the Fed operates in such obscurity that nobody really knows what it does except people who maybe read The Creature from Jekyll Island, they still generate some political heat for taking rates under zero, because by now even the Joe Sixpack has figured out that when the Treasury is paying, when the federal government is paying interest rates below zero, you're cheating savers, and this is just the wrong time to dig into savers that way. So no, we're not going to see negative rates, but the Federal Reserve has put itself in a position where it cannot afford to let rates get away, because it's going to essentially ratchet up the burden of debt on all debtors, including obviously government itself. So they're going to be between a rock and a hard place, because when the hyperinflationary idea kind of gets out there, when people start suspecting that it could actually happen, interest rates are going to need to go up to assuage those fears, but the government won't be able to let them loose. And what that means is that the Federal Reserve will be stuck sucking up 100% of all Treasury paper. They're going to have to be buying every bit of it, because there won't be any buyers at the market throughout the rest of the world.
With the U.S. government spending billions of dollars to keep the economy afloat, where is this monetary inflation likely to show up?
In the end game, really, when the Federal Reserve, when our federal deficit is 90, the federal debt is national debt is 60, 80 trillion dollars, whatever. But my gut feeling is that as fast as they can stimulate and monetize right now, it's not even reflating the asset base. We're losing more in asset valuations than the Fed is putting into play by way of stimulus. And that doesn't even include what we haven't lost yet in the real estate market. The real estate market is doing a Wile E. Coyote, just kind of hovering there in outer space, having gone off the cliff. But I can promise you, I can guarantee you that when real estate starts to thaw and people are out actually shopping for homes, their bids are not going to be up there near the record levels of February. They're going to be very cautious buyers, and for that reason, I think that real estate is going to get back into motion with home prices 25% below where they were. And I think that's a conservative estimate. That would be most of what was lost in the crash of 2007 and 8, when the average U.S. home lost about 33% of its value. So I think we're going to open 25% down, and that puts all this bailing out in perspective. The Fed is behind the scenes jockeying around to support paper. They're just supporting paper markets. And as far as I'm concerned, that's the easy part of it. That's no sweat. They can always get in the repo market and scare people into thinking, hey, everything's okay, or at least the Fed's making them okay. But can the Fed get into the bailout business with the hard cash that they'll have to come up with to make everybody's mortgage payment? So they are not going to be able to boost that asset, the real estate market. It just won't happen. And for that reason, I think that I give deflation the edge right now.
Are consumers likely to want to and be able to increase their debt loads?
No, and that's why the trillions in stimulus is going to stimulate approximately zero. If it's $2 trillion, whatever wound up in the bank accounts of Joe Consumer, that will be almost zero stimulus. If I wanted to make an argument that it's all deflation, then everything that got deposited into people's bank accounts will have the net effect of just keeping their landlord solvent for another few months. That's all it's going to do. And of course, to take the deflationary aspect of it a step further, the landlord owns a property that's decreasing in value. So there, just to account for one specific area of stimulus and how it could not only not stimulate, but how it could get essentially sucked into the maw of deflation. That's it.
Is consumer spending likely to be a key component of an economic recovery?
See, there you can just look at your own life. We're all kind of wondering at the abstract level, the political level, where we've got stimulus and the charlatans at the Fed, quacks doing whatever they do. We ask the question, and I think it's a question the mainstream media would pose, is it going to work? But just look at your own life. You get $1,500 deposited into your account. What are you going to do? Rush out and buy a Cadillac? A bass fishing boat or something? No. All of it's going to be held against a rainy day. With the sequestration, there's not much to be spending all that money on, certainly not the high living at restaurants and this and that. And so forget about the consumer. The consumer is scared out of his gourd right now, particularly baby boomers who are coming up against retirement and toting up their assets. And I think the accounting's going to look a lot darker if this market takes a second leg down, which I really expect.
Is this economic environment bullish for cryptocurrencies?
I don't think so at all. I don't think it's bearish for crypto, but I noticed that crypto is trading as we speak at 75.47, and it's been as high recently, I think, is around 12,000. So it's not exactly airborne here. It's just kind of holding its own, and I think that's reasonable given the possibility that maybe crypto money will be useful, particularly if there's some, I use this word in quotes, but fearfully a problem in the banking system.
Would you be a buyer of U.S. real estate right now?
Not even remotely. I'm thinking back to something that Jim Grant put out maybe 20 years ago, and it was the anatomy of the prime commercial real estate in New York through the years of the Depression and thereafter. And it turns out that even the bluest blue chip commercial real estate is not going to hold its value over, well, in our case, a prolonged depression that we never officially came out of. It took the stimulus of post-World War II, the economic rejuvenation of the country, to finally get us out of a long slog that was mostly depressionary. So on the commercial side, we were already having somewhat creative destruction with the REITs. They had finally figured a way to make the malls, if not pay for themselves, at least to avoid their collapsing, all the mall REITs, by converting them into multi-use with office and residential and some commercial. But you look at them now and you think even the big box operators, they're all dead ducks now. And a couple of weeks ago there was a story out about how the landlords, the mall landlords, were compiling blacklists of tenants who didn't make their payments on the 1st of April. But when you look at the tenants that are bluest blue chip mall anchors, like Dick's Sporting Goods was one of them, and Burlington was another, what are you going to do? Kick them out? So there again, you see the deflationary chain, because the biggest retailers are stiffing their landlords, and of course that's not where it ends. The landlords have their own payments to make and checks to write, so it just sort of works its way through the system. And on the residential side, I've already I think I've accounted for that. That's not a buy either. So you got to be nuts. The only real estate that I think would be appealing is, let's say, a warehouse that has a bomb-proof tenant. Some company that has a contract with the municipality to recycle waste or whatever. So if you see a commercial space that's rented out and a tenant that's going to survive come hell or high water, that's okay if you want to get into real estate.
What markets are you continuing to keep a close eye on at Rick's Picks?
Well, I'm finally able to like gold almost as much as some of my subscribers, so we're watching it pretty closely. But I have to say the emphasis is still on trading, and even though the markets had these wild swings, I'm encouraging my guys to not try to be heroes. Instead of taking the wild swings and, let's say, going home on Friday, long gold or long E-mini S&Ps, I'm just trading very conservatively myself, small stuff intraday. I'm trading it almost the way I would if the market were boring. So, that's just looking at it like a trade. But if you want to take another perspective and say, well, what's investable here? I'm sorry to say that everybody finds the same thing the same hour of the day. It's like, original thinkers are out there, geniuses buying Amazon and Netflix, because we're all shut-ins and they're doing good business. But, unfortunately, that world of stocks that moves nicely on stories that we can all understand, they've already made their move. So, they're not exhausted. I today did a little bit of Beyond Meat myself, because I think that the news media, the moment they mention that meat packers have been closing down, I can see the meat counters being completely sold out over this weekend. And of course on Monday, that's going to dawn on a few investors, the consequences. And so I'm looking for a pop in Beyond Meat, currently trading for 108.78. I think it's going to get at least to 145 and change. So I would stick with the story stocks. I'd stay away from dividend stocks because they're all going to cut their dividends anyway. And dividends are not going to compensate you when the stock itself falls 20 or 30 or 40 or 60%. So there you can just apply the Peter Lynch idea. If the story makes sense to you, buy the stock.
Rick, you had an interesting idea on how millions of unemployed people could be put back to work and do a good deed at the same time.
I have this didn't originate with me. I've got a friend who was a theater producer, successful in the nonprofit sector, and he's, let's say, a man of the left. He's way to the left. But he said, he came at me with this idea, and he said, this is something that doesn't matter whether you're left, right, Republican, Democrat, progressive, liberal, everybody's got to love it. Very simply, it would be what I would call the National Service Corps. And it would be modeled on the earlier example of the Civilian Conservation Corps of the 1930s, and a couple years later, the WPA, the Works Progress Administration. So this is a way of taking every one of those 25 to 30 million people who are going to be unemployed and giving them a job if they want it. It will take the U.S. Army to do the training and the housing for this workforce, but you know that they're up to the job. There's a lot of Army barracks even that are vacant, but the Army could build camps, work camps, and within the Army, there are resources to train everybody. They can train not only people for building bridges, they can train accountants and lawyers. The Army has that kind of reach. So, and we know from the World War II experience that we can ramp up a pretty well-trained workforce really quickly. It helped to put 8 million women in the factories when men went off to fight the war. And when you look at the Civil Conservation Corps, which was all men, it was all relatively young men, we got a pretty good deal. The initial capitalization of the WPA, for one, was about $5 billion, which in today's money is $5 billion. Today that's about $90 billion. So we're just squandering these bailout sums in the trillions. They're not going to get us much. But if we put a workforce, we train a workforce, we can build that infrastructure that President Trump has said so many times he wants to do it. So we've never had a better opportunity to do it and to get good value for our money. The wage scale would be such that we could get a $50 million bridge repair for maybe $20 million. The unions don't have to worry. I think it's that a parallel pay structure would be compatible with the existing union wages, and could be on a sliding scale. The more people who get trained and work their way into higher paying jobs, the more flexibility the union should have to raise their own rates. So I don't see how anybody could object to that, the idea that we have a work training program, and it would help us to kind of start with a fresh slate with our last effort to do job retraining. For the most part, it was for the benefit of people who had been displaced from manufacturing by robots. And I know there's a lot more to it than that, but to broadly describe it, we had job training for people put out of jobs by robots, and they mostly wound up working at Walmart. Again, that's oversimplifying it, but this would give us a chance to get it right, essentially to put together a job training program that trains up all of the unemployed into jobs up to levels where they're really useful to the economy of the future, not the present or the past. So we've got a great opportunity to train a workforce and to get a really good deal for our money. And I think they should get this thing going right now, because when unemployment benefits start thinning out in July, August, September, we're going to have problems. You know, we could, it only takes a couple hundred activists in a city to really touch things off. So I think this is a good way to head that off, to get this program together on war footing. Do it now, do it quickly, and we won't see those problems in the cities. So that I'd say that's in a nutshell, but I think it's pretty much the way I've thought it through. And again, I like it so much because it was presented to me by a hardcore leftist who said, this is great. It doesn't matter which party proposes it. It's going to happen. And it doesn't seem to have gotten any political traction yet. I've heard no mention of this from politicians. But even there, we don't need politicians to get it going. If the news media or the media pick up on it, and I put you in that group really, it'll get traction. If enough people will it to happen, the political side of it is going to happen as well.
Where can people find out more about Rick's Picks?
Just go to rickackerman.com. We've got a great $1 special, free, not a free trial, but if for $1 you can get 2 weeks worth of Rick's Picks, access to the chat room and my daily trading recommendations. The trading room is a great place. There are hundreds of people who come by there over time. Some of them are some of the best traders I've ever come across, and they're very helpful bunch. They put out excellent trading ideas in real time, and it's a great place. So again, rickackerman.com. Just click the trial link up at the top, pay $1, and you'll be on board.
Rick, thank you so much for being on This Week in Money.
Well, I appreciate the opportunity to chat with you, Jim, and certainly to connect with your audience. So thanks for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. He was speaking to us from Florida. Coming up, Wolf Richter, next on This Week in Money.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, with the coronavirus panic and the shutdown of the economy, what do you see ahead for real estate?
Well, that's a tough and good question. In terms of what we're seeing right now, we only have early indicators such as some weekly mortgage data and similar tidbits. We're looking at a decline in sales volume for April, roughly in the 30% range, maybe more, and in some cities probably quite a bit more, in others less, depending on different phases of the lockdown. So it's gotten very difficult to even sell a property. So if you have a willing buyer and a willing seller, it is difficult to show the property due to social distancing. It's difficult to close deals. I mean, everything is now difficult. In addition to that, we're facing an unemployment rate of 20 to 30% over the next few months, and we just got the initial unemployment claims today. So now 25 million people have filed for unemployment over the last 5 weeks. So that's in the United States, where not everybody is eligible to file for unemployment. So our unemployment rate will be in the double digits, easy, and will grow from there. And so this is a reality that concerns a lot of people, even that do have jobs, so they're worried about losing their jobs. And many of those people will be hired back as soon as their companies reopen, but not all. So there will be quite a bit of unemployment going forward, even after the lockdowns are being loosened. And this creates an environment where there just is not a lot of demand for home purchases, and it hit at a time when home prices were at record highs, and in many markets incredibly inflated. You also have lenders tightening up the mortgage standards now. You have this whole issue of forbearance, where homeowners are currently allowed to not make mortgage payments And so this has to be arranged with the lender, but this is a government-mandated option that is now available to many homeowners. So this creates a real mess, because now you have all these mortgages out there that are essentially in forbearance, and last figure I heard was like 6% already of all mortgages outstanding. This continues to grow, so you have a mortgage market that is in turmoil. And the Fed has stepped in trying to calm it down by buying mortgage-backed securities, but essentially the whole mortgage market that backs the housing market is in turmoil. Potential home buyers are worried about their jobs, so that those that still have jobs, and sellers are worried about having infected people walking through their house. So yeah, what we're seeing right now is essentially a freezing over of the market. So there are very few deals done. Sellers are hesitant to put their home on the market. Homes have been pulled off the market in very large numbers, and buyers are just not interested. So that's the first phase. The market is going to freeze up. There's just not going to be a lot of transactions. Then when it gets loosened up, there'll be some sort of price discovery. And that will take time, and real estate moves very slowly. So I think that price discovery won't really happen in serious until the era of forbearance is over. So when people have to start making the mortgage payments again, and then they don't have a job anymore, and then they have to sell the house, or it goes into foreclosure or whatever. Then you have a lot of forced selling going on, and that's when the price discovery gets more serious. So I think there will be a slow, very tough process ahead for the housing market in most parts of the country. I don't see any way for prices to be able to increase in this market. With this kind of unemployment, with the uncertainty that households now have hanging over their heads, I think the demand just got whacked out from under the housing market. In addition, there's due to the travel restrictions, we lost the non-resident foreign buyers, particularly the Chinese buyers, non-resident buyers that are acting as investors in the market, and they're buying homes, or were buying homes for investment purposes and not living in them. And that has essentially been shut down. In some coastal markets and some other markets too, that played a fairly significant role. It might have only been 5 or 10% of all the sales, but prices are set at the margin, and these investors are less worried about making a good deal and more worried about getting the money outside of their country. So that put a lot of upward pressure on the market when they were still active, and now they've been locked out. In addition, we have a large domestic investors, so companies that buy homes and rent them out, and they have tens of thousands of homes. They have stepped back from the market. Some of them are publicly traded. Their shares have crashed. And then there's this whole concept of iBuyer, where a company buys a house and then flips it to a homeowner, to a purchaser. And this became pretty popular. So Zillow got in it, and Open Door, and a startup that is backed by SoftBank, and iBuyer, a company named that way, and many others got into this, where they would essentially, instead of being a broker, they would actually buy the home and resell it. And they're turned into professional flippers. And this whole thing has shut down completely. So these companies have laid off the people that were, a large part of the people that were dealing with us. They have stopped buying homes altogether. This whole system has come to a grinding halt. And so this is so these three factors, the non-resident foreign buyers, the large domestic investors, and then the iBuyers, that was quite a force under the housing market recently, and that has just gone to zero essentially. So what's left is local home buyers, and they're dealing with an economy that's looking at 20 to 30% unemployment, and I just see there's an awful lot of trouble ahead for the housing market.
What's happening to real estate around the world that's owned by people in China? Are they selling it off to cover their debts back home?
Yes, we're seeing some of that. That's particularly evident in Hong Kong and there's a lot of mainland Chinese, obviously, activity there. And so that's been a big part of driving up Hong Kong housing prices. Now, there has been a huge problem with debts in China and households, companies all around. And China went through its own lockdown. It just had horrible GDP performance. I mean, they're struggling with everything we're struggling, except they're a little bit ahead of us on this. And so the Chinese investors have pulled back, and even in markets where they weren't locked out, and that force is pretty much gone. I don't know how long they will stay that way. It could be it could just be a shift in sentiment that will last for a long time, or it could be a relatively short-term blip that after 6 months or a year, when all settles down somewhat, that the Chinese investors will return to Hong Kong and other markets. So the jury's still out on that, but right now they're not buying. They're trying to unload some of the properties that they have bought, and they've become net sellers in some of the markets we're looking at.
We'll have more with Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, are automakers cutting back on production for the 2020 and 2021 model years?
Yeah, so right now the manufacturing plants are shut down. Most of them are completely shut down. And so this will be for the 2020 model year. That's what we're in right now. That's the end of it. The 2021 model year will start in a couple of months. And right now, the plants are shut down, and the component plants are shut down. They're starting to come back online in China, but U.S. assembly plants, the Mexican assembly plants, they're in Canada too. They're just not making cars. So there's also no demand right now, and the weekly numbers I'm looking at indicate a 60 to 70% plunge in new vehicle sales, and similar plunge in used vehicle sales in the United States in April so far. And so you have a collapse in supply, but you also have a collapse in demand. And everybody's now waiting to see how much demand there will be. What we have got is a huge, big, fat pipeline of recent model vehicles coming out of leases and out of rental inventories. So that's millions of vehicles that are 1 or 2 or 3 years old, and they can't be stopped. They're going to hit that market that's not buying right now. So, and they're competing with new vehicles too, because they look similar to a new vehicle, and they're a lot cheaper. So the whole industry is now scared that this will lead to a collapse in used vehicle prices, which will make selling new vehicles very difficult. So this is a quandary of the new vehicle side. And on the used vehicle side, it's just going to be a mess. There's a real market there. The market is now sort of frozen, but there's real price discovery. And when that takes place, or when the auction buys again, and when it's happening, you will see that price discovery at work. And given the onslaught of supply that we're looking at here, and the dearth of demand that we now have, I think that the pricing action will take place in that area, where at the 1 to 3 year old used vehicles, and they will pull down the pricing on new vehicles. So manufacturers will have to come up with lots of incentives to sell those new vehicles. They will have to compete with those used cars, and so it will be a very, very difficult period for automakers. I think they're not too eager to overproduce. So they will start production, but they don't want to load up the dealer inventories given the troubles that we're having. So I think they will be careful trying to overproduce. The last thing anybody wants is millions of new vehicles that are parked everywhere that nobody can sell. That will make the situation worse. So when they're restarting the plants, probably, they're thinking about it now. They're far from it, but they're thinking about it now how to do it. Many plants will restart with 2021 year models. They'll skip the current model year or stop it. And so it'll be new models. There'll be few of them. Ford, for example, has already cut out a bunch of car lines, so it'll be simplified. I think they're looking at a very tough environment, and they're trying to not make it worse. They can ramp up production next year if they need to. If those vehicles are sold out of inventory, it's time to add supply. They can ramp up production. But in terms of the remaining 2020 production, I think it'll be so this year. It'll be modest.
So, in a nutshell, this looks like it's going to be a great car buyer's market, whether you're looking at new or used.
Yeah, that's how I look at it, especially on the used car side. On the new car side, there are volume incentives. There have been in the past years, and these volume incentives are now irrelevant because no dealer is ever going to hit them. So on the dealer side, there are no incentives to make any deals right now because they're getting paid on these volume incentives, and they can't meet them. So they might as well try to make a profit where they can. So right now the market's a little bit frozen on that, and I've heard that in many cases people were going out trying to buy a new car and expecting to get deals, and the dealers are not willing to make deals because they can't get the volume incentive. They don't have any incentive from the factory to do that. But I think they will loosen up. We've already seen the first movements on that. So right now it's just frozen over, and you have to wait a little while and let this sort out. And when the manufacturers start to come out with incentives to get the market going again, when this takes off, then it will probably be a great time to buy a car. And in terms of used cars, if you can even buy one right now, it's probably a good time. You can probably negotiate a pretty good deal, but I would assume that a month or two from now, you might make you could get a better deal.
Is the return of manufacturing to Canada and the U.S. an important component to get these economies on stable footing again?
Well, I surely would like to see that. I don't know how realistic that is. The labor-intensive manufacturing will not come back, but automated manufacturing will be a great thing to have reshored, and some of that is probably going to happen. And so when you have a highly automated plant, you have very few workers in it, but those workers that you do have in it, and the workers that design and build the plants and the robots, that's highly paid work. And those jobs are great jobs. And people that work in these automated plants often have college degrees. They're working with robots and software, and so many of these jobs are really good to have on board. And so I would like to see that. Now, robots cost the same everywhere. They're really the big equalizer. And so if you have a highly automated plant in China or in Canada or the United States, the only differences would be taxes and environmental regulations and being close to the suppliers and those kinds of things. But in terms of labor costs, it would be relatively minimal because most of the work is going to be done by robots. And so I think that we'll see some of that. We'll see some of the manufacturing being expanded in the United States. And that we'll have to wait. It's a little early to see that, but I think some of the enthusiasm for making stuff in China has deflated.
Two questions about robot workers. One, will they put a tax on robots to make up for the lost incomes from the people laid off? And B, will we see more manufacturing in North America, because we've learned through the coronavirus crisis that China's an unreliable supplier?
Yeah, in question one, we already put a tax on payroll in the United States, a payroll tax, so there's a lot of logic in putting a tax on robots. I don't really know how you calculate that, because, robots are not necessarily humanoid-looking things. They could be software applications that you can't really see operate, and they can be big mechanical equipment, very large-scale equipment, that you'll see in big plants, and so it requires some thinking as to how you would want to do this. But we tax employment, so we might as well tax robots. I think there's some logic to that. On the other hand, we give tax benefits to companies when they invest in robots. So, I mean, we encourage them to invest in not just robots, but just in anything. We have an investment tax credit, and to encourage investment by companies. So this goes kind of counter the idea that we would tax robots or tax robots for the work they do. But it makes sense from that point of view that we tax employment. We might as well tax robots when they do the work. In terms of China being an unreliable partner, that's starting to be a particular issue in the pharmaceutical industry. We have shifted pharmaceutical manufacturing to India and to China, and that has caused all kinds of issues, from contaminated medications to other problems. And the value of labor in a pharmaceutical product is minuscule. So producing that in China versus producing that in the United States really wouldn't change the cost all that much. You would save a lot on transportation costs. You would save a lot of management issues. Liability issues could be lower. So I think in the pharmaceutical industry, there's a lot of thinking right now on that. Now, some of the products that go into medications are also made in China and India, most of them. And so you would actually have to bring that back to really make any difference. So I think people are seriously thinking about that after all the issues we've been through. In terms of the component manufacturing, if there's a lot of labor involved in making these components, and if it can't be automated, I don't think it will come back to North America or to the United States and Canada. They may be made in Mexico, but labor costs are very high here, relatively speaking, and so if you can get a cheap labor country to produce the same thing for a lot less, companies will likely do that. But things that can be automated and that are expensive to transport, or there are big liability issues and reliability issues, I think there's a lot of thinking in that direction. It's complicated to change the supply chain. It can't be done overnight. You have to build the facilities here, and you have to hire and train the people that do all this stuff. And since we haven't really done it in a long time, so these activities are readily available in China, but we've sort of given up on it. And there's a lot of work to be done here. But I would like to see that. I'm not sure how rapid that will be, but there are a lot of discussions on that right now. And we will probably see some of it.
With U.S. unemployment now near what it was back in the 1930s, could we be in for another great recession?
Well, we're already in a very steep recession, and the hope is that it won't turn into anything worse. That's the hope. Nobody wants another Great Depression. I believe, from what I can see, that this recession is deeper than the Great Recession of 2008, 2009. I don't know how long it will last. It could last longer. There's a lot of indications that it will last longer, in part because of consumer confidence has it's taken a big hit, but just not briefly. But we still haven't solved the health issues. So long as we have the health issues, in the United States, 60,000 people have now died in 6 weeks of the coronavirus. So, and that's just the beginning. So we're looking at a situation that has not been resolved, that's going to stay with us until we find a way to deal with it from a health point of view. Consumers are not going to get very enthusiastic about spending money. And so I think this has a potential to drag out for quite a while. And even though quite a few people will be hired back, of the ones that have been furloughed, there'll be plenty that won't be hired back. Brick and mortar retail will never recover properly. I mean, that has already been under heavy attack from e-commerce before. And so now I think there will be thousands of mall stores that will never reopen. And so you have whole sectors essentially being decimated permanently. On the other hand, there's some booms going on online. That's just incredible. Online sales are booming. And any company that had a good online presence is benefiting from that in the e-commerce section, whereas the brick and mortar section is dead. So I mean, there's these huge shifts. And we don't really know how this is all going to work out, but it takes time to balance out those shifts that are now happening. And so I think we will look at a very, very deep recession that could last fairly long. And the hope is that we will not see a Great Depression. I kind of go with that, but I think the recession is going to be pretty messy.
When the economy gets back to normal, or the new normal, are you planning to make any big purchases?
Personally, yeah. So we are among the households who have not been hit by unemployment, and this is kind of an interesting example. My wife works for a company that's in the food supply chain. So she goes to the office every day, and so she drives from San Francisco to Silicon Valley to go to work every day. And they have adjusted to work, so the public doesn't go in there. It's just an office environment, and they're having shifts, so they're spreading out further. People don't come all in at the same time. They're moving lunch times around, and they're trying to avoid contact. And there's hand sanitizer everywhere, and they're cleaning their keyboards and doing all these things and wearing masks, and trying to stay away from each other. So they're doing the social distancing and the hand washing thing and hand sanitizing thing at work, but they're going to work every day. And my business is this website, and I'm working furiously every day. So even though advertising revenues, as everyone in the media knows, has gone down hard and continues to do so because advertisers are cutting back. There's no sense in advertising if your store is closed. And so we've seen that, but my traffic is really good and it's way up. So, I mean, it looks good from that point of view, but I definitely see the collapse in ad revenues, and that is clear. So we're in the situation we're both working. We don't expect this to change, and we just bought a car in February before all this happened, a used car, and from a rental fleet, and so we don't intend to buy another car. We don't intend to buy a house. We're happy where we are. So we didn't really have any big ticket items on our list, but if something comes up that we need to buy, we're not too worried, about buying it because we're continuing to have our jobs. And a lot of Americans are in that position. The others are not. Others are cutting way back. But it's sort of split that way. And you'll see that in e-commerce. E-commerce sales are just exploding. And Americans are spending their money, but they're not spending it by going out. They're spending it online. And we probably belong in that category. And we try to support the restaurants in our neighborhood that we like to go to. They have now switched to takeout only, so we try to get some meals there, and we do those kind of things. But in terms of big ticket items, we don't have anything on our list right now.
I'm really looking at a soaker tub. With jets and everything. I think that would be a nice big purchase. Wolf, how can people find out more about Wolf Street?
wolfstreet.com. So it's business, finance, and economics, no politics. Everything is free, and we have a very vibrant comment section, very well behaved commenters. So venture down there, there'll be hundreds of comments under these articles. Very interesting stuff. So come on by.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, Wolf Richter, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with American Manganese President and CEO Larry Reaugh. Welcome back to the show, Larry.
Well, Jim, it's always good to be on the show.
Larry, what's been the overall effect of the coronavirus on the markets?
Well, the overall effect, of course, is that the market has cratered, and, because basically industry stopped dead in its feet. You look around, just this week you're starting to see more vehicles on the road here in the lower mainland. But before, you could, you saw, they were hundreds of feet apart when the traffic was going, so there wasn't many vehicles on the road. It used to be bumper to bumper. So how does that affect everything? Well, it certainly affects the fundamentals of the oil industry, because all of a sudden in North America, nobody was lined up at the pumps. They pumped gas into their vehicles because they were going nowhere. So you got a oversupply, a basic fundamental, and the price of oil cratered. We're already starting to see some bankruptcies in that area in the U.S. and in Alberta, and you'll see more of them as time passes. And I don't know. I think that the government should be looking at building some type of a cheap reservoir to put the oil, so that they can ease it out into the market when the market comes back. And in the meantime, the big oil companies will survive. The other junior companies that had 3-4 months working capital could be in real jeopardy. And that's a major effect that I see, aside from the fact that every restaurant's closed. Everything is closed, especially for small business. How many of those will survive, I don't know. How many people will be called back to work? It's going to be a lot less than we anticipate. So the overall effect is going to be the economy is going to be down for a while, and but the markets are struggling to come back, and I think we're probably in decent shape in that regard.
What kind of an effect has the coronavirus had on the operations of American Manganese?
Well, that's interesting. Certainly, we've been a lot busier. We had, some of our people working from home. We had, like myself and a couple other people coming into the office all the time.
And so it didn't interrupt our business schedule. It interrupted our projects because we had to depend on outside companies that were contracted to do those, and eventually they'll be getting back to work. But there's also there's a silver cloud and the silver lining in this black cloud, and that is that we're getting a lot more interest in our recycling program. For example, we've got people, a lot more phone calls, a lot more interest in moving ahead with what we're doing. It seems like everybody now is concerned about certain issues, certainly first and foremost is the environment. But they're also interested, in critical metals. They're interested in how exposed they are to China. And, the basic thing is that a lot of these high-tech situations that we're involved in, like EV cars, are dependent on China for critical metals and rare earths. And the exposure to the virus has really pointed up just how weak the system is. And I think there's going to be a big move forward to strengthen the system and make sure that you can get your critical metals when you need them. And, that's great for us because we got projects in that area. Not only in the batteries, but we've got projects in manganese.
How has the virus affected your operations in Arizona?
Well, we haven't had any operations going on, but we do have. We're located down there, and we have developed a process that is patented that could make the U.S., less dependent or totally independent when it comes to manganese, which is one of the top critical metals. And we're getting interest in that area, and I'm hoping that we can proceed on some of the things that have been proposed to us. That in itself is showing me that we're in a different era, and instead of taking lengthy times to commercialize a project or do anything like that, they may be sped up. And because people will not just be waiting for you to turn out the final product, but they may want to be involved in it, and that's been a big part of our campaign for a couple of years now.
And you've talked about patent infringements in the past. Anything new there?
Well, I just read about a patent infringement with Tesla, whose allegedly patent had an infringement on a patent that's held by Nikola, and that's a $2 billion patent infringement. And believe it or not, it's on the design of the semi truck, and it is something that basically, and the Tesla tried to get it ruled out, and it hasn't been, and it probably will not be. So that tells you how strong patents are. I had an interview a week ago with a company called Crux out of the UK, and they were trying to tell me that proprietary was just as good as patents. But one thing about a patent, it's everything that you've got is there's a record of it. It's in the patent office, and if you have proprietary information, then you're probably the only one that has records of that. So it's a lot harder to defend that. And so we feel that our patents are our strongest asset in the company, and I include the manganese patent in that, as well as the patents for recycling, and our applications in other parts of the world. That will protect us. People are concerned that it doesn't, but you only have to read about a patent infringement like this $2 billion patent infringement that Tesla's involved with. And it begins to show you that, maybe patents are really something that a company requires if they've got some specific intellectual property. And if they don't patent it, maybe it's not patentable, so that proprietorship doesn't work. And you've basically the patent is your lifeblood at the end of the day. So I'm really happy with ours. And I think that going forward, that this will be more and more recognized by our shareholders and new investors. So, this is not going to sit there forever. I looked at the development by Goodenough, one of the Nobel Prize winners, and they figured the timeline on a flow battery or a battery that he was working on was could be up to 8 years. And I think that this coronavirus will take that timeline and cut it in half because people can't wait around for something to be commercialized. By the time it gets commercialized, there's a lineup at the door, and so any smart company will be wanting to get involved in the development of a commercialized plant, and I think that will come sooner than later.
Larry, how can people get more information about American Manganese?
American Manganese is a TSX Venture Exchange listed company, and we have a website out there, AmericanManganeseInc.com. We have you can contact the company by emailing us or myself at lreaugh, LREAUGH, at AMYMN.com. Or you can phone the office here at 778-574-4444. And we trade on the Venture Exchange under the symbol AMY. We trade in the U.S. under the symbol AMYZF, and we trade in Frankfurt under the symbol 2AM.
Larry, thank you so much for the update.
Thank you, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on April 24th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.